Good morning, ladies and gentlemen. I'd like to invite my colleagues up on stage, my panelists, Yuki, Eric, and Zubin. Thank you. As they come on stage, I'd like to just trigger a Slido poll that we are going to be asking all participants for the opening plenary. And if you could all just whip out your mobile phones and scan this QR code, there is a question that we would like to ask you. And that is responsible investing in Asia in the past year progressed, regressed, or neither? And we shall wait for the responses to come in. Okay, so whenever the results are ready, we can have them on screen. Okay, so as we wait for the results to come on, I'm delighted to introduce the opening plenary, Responsible Investment in the Age of Disruption. I'm so delighted to have with me our panelists for this morning, Ms. Yuki Yasui, the Managing Director of the Asia Pacific Network at GFANZ, Mr. Eric Lim, Chief Sustainability Officer at UOB, Mr. Zubin Darbu, the Managing Director of Bank of Singapore, and last but certainly not least, Derek Baraudi, Head of Banking and Capital Markets from the World Economic Forum, who's actually dialing in from New York. Thank you so much, Derek, for joining us, and thank you, panelists. I'm going to dive right in because, I've kind of opened the conversation earlier about responsible investing, and we really want to talk about where has this been going, how much has progressed, and what are we looking at in the future? Do we have the poll results that we can just quickly flash on screen to just get a... Okay, I'll come back to the poll results in a little bit. I'm going to come to Yuki. Yuki, you are at GFANZ, and GFANZ, is the alliance of financial institutions that are obviously making pledges towards the net zero commitment. You have had this global view and then also the Asia Pacific view. Can you share with us how do you think this has progressed?
Yeah. So thanks very much, Jessica and Eco Business, for the invitation, and delighted to be with all of you today. So as the Minister has introduced, and as you have kindly introduced, GFANZ has nearly 500 members now around the globe, representing 40% of the financial assets around the world as well, which is significant, but it still means that there is 60% that is not part of the net zero community of GFANZ, and we hope that there'll be much more coming on board. In Asia, we have about 80 financial institutions that are part of the community and is growing. And the APEC network was launched in June this year. I think we're kind of, as everyone in the introductions so far has mentioned, we are really wedged between the energy security and the energy price increases and the natural crisis that we have, the planetary crisis that you introduced as well. So it does mean that the imperative for a real structural economic shift to net zero, a social shift, a economic shift, financial shift, and a whole global shift is really needed now than ever. And one of the priorities that GFANZ is trying to tackle is the mobilization of capital in the finance world to the real economy for that transition. And nearly 50% of the global emissions is coming from Asia, and out of that, 80% is concentrated in just 4 countries in Asia. That's China, India, and Japan, and Indonesia. And so the GFANZ transition guide that is going to be launched at the COP this year is going to be talking about 4 financing strategies that actually makes the sustainable finance journey more complicated, but much more nuanced. And we hope that that really shifts the spotlight on how much is the financial institutions really contributing to the real economy. Because I think there's often an isolation between the two. And so the 4 financing strategies that are put out in the guide talks about financing for climate solutions, financing for companies that are already aligned to 1.5 degrees, but then also financing or supporting financing and financing companies that are trying to align themselves to the 1.5 degrees, so not getting there, but trying to do that. And also the managed phase out. So this is managed phase out of high emitting assets. So how do you support coal-fired power plants to retire early? And this is a big challenge in Asia, where a lot of the coal-fired plants are quite young compared to Europe or North America. How do you get them to be on the 1.5 degrees?
Thank you so much, Yuki. I think that's a good perspective we have on the global stage. And now that we've heard, a global overview, I want to go to Eric. From the commercial bank's perspective, how are you viewing the progress that responsible investment has made? How is the bank thinking about it? We've had Minister mention about banking commitments as well, and would love to hear your perspective on that.
Thanks, Jessica. I definitely got that finger-wagging moment from Minister just now. I think both OCBC and us are on the hook on that. So I kind of whispered to Min Grace that we're going to be announcing our net zero pathways before COP27. So she gave that semi-satisfied nod, and so we'll follow up with her. Thank goodness for that, right? But I think that that very fact that we're working on that says a lot about the shift as to what's going on. If you think back to a couple of years ago, this concept of sustainability was, yes, we'll explore it, we'll figure out where the commercial opportunities are, we'll build the right products and see if it takes. 2 years, 3 years into the journey, I will tell you our personal experience, and we see this across the market as well. Green and sustainable finance has exploded, right? Min, Grace, as well as Jessica both alluded to the fact that green, sustainable, as well as sustainability-linked financing are on the rise. Our book has tripled in terms of green and sustainable financing in the last 2 years, while the conventional book has grown at less than 10% a year. So the commerciality is clearly there. The question is, what's driving the commerciality, right? And it's no longer this sense of you got to do the right thing. It is absolutely you have to make your business resilient for the future. Business leaders are getting it. Board members are getting it. Sustainability is a part of business strategy and operational conversations, both in terms of the green sectors, but also hard-to-abate sectors, right? So it's very clear to us, green and sustainable financing is now the easy plebeian thing of yesterday, right? The conversation is now shifting to transition finance. What do we do with the hard-to-abate sectors? Because if you look across ASEAN, right, ASEAN is in a development growth mode. And as UOB, we're a Singapore domiciled bank with a strong ASEAN focus. We need to be able to support that development and that growth, right? As ASEAN grows, they're going to need more and more energy, right? And 70% of all greenhouse gases today are in some way, shape, or form related to energy generation and energy use. So being able to finance the energy transition, as we talked about, is the next hard but absolutely critical part of the conversation. And I think as you look at a lot of the geopolitical tensions that have been going on, as painful and as tragic as it is, I also think it's brought a new lens into the conversation. The conversation of not only transitioning towards low carbon, but how do you achieve net zero in 2050 while taking care of things like energy security, energy access, energy affordability? Because you've got to be able to deliver to a just transition even as we decarbonize. So definitely a trend that's here to stay. We see the conversations in all parts of the main economy now. We see the huge commercial opportunities, but more importantly, I think there's a maturing of that conversation into just transition, especially for our part of the world.
Thanks very much, Eric. And I think, we have BDO Bank in the room as well, and they had made some commitments around co-financing and, recognizing the difficult challenges. And we're going to have a panel on financing the net zero transition later. But you brought up some really good points about some of the pain points that, the financial industry really needs to address. So thank you for that. And I'm going to come back to that in a little bit. But over to Zubin. I mean, at Bank of Singapore, you manage a lot of people's money, and responsible investing has obviously been on the rise. So it would love to hear from you. How are investors thinking about that? How are you, as a bank, then providing the kind of products that you're seeing the demand from? Over to you.
Good morning, everybody. It's good to see so many people in person after the amount of Zoom events we've had over the last couple of years. So, and huge congrats to Jessica, you and the eco-business team for putting this together. I think to start with, it's useful to get a sense of the perspective on the mega trends affecting our region. There's rapid urbanization, which results in a lot of CO2 emissions. There's a tremendous amount of wastage. There's rising inequality, which puts stress on resources. There's clearly climate change. And if you put these together, and you look at an issue such as food security, which the minister alluded to, by some estimates, food demand is expected to rise 30% by 2030 alone. On the other hand, Asian economies are facing issues on food security and inflation, the likes of which we've never seen before. If you look at the challenges in front of us on climate change itself, it's estimated to be about a $28 trillion loss in our part of the world if we do nothing in the next half century. Our perspective at Bank of Singapore is that these challenges also provide opportunities. And the good news is that if you look at the next gen's really driving a shift in mindset, a shift in capital allocations towards these responsible investments. Look at the ecosystem around us. It's already started working. It's working on areas on sustainable cities and communities, on food security. Singapore has the 30 by 30 plan, in areas such as carbon trading or alternate energy. So the momentum has clearly started. If I look at us as a Bank of Singapore, as a private bank, as a wealth manager, we believe our core business allows us to have those positive levers to make those societal and environmental kind of impacts. And our sustainable strategy seems to be well placed to kind of meet these Asean challenges. We've started using ESG lens into almost everything we do on investments. And fortunately, we're part of the larger OCBC group, and we leverage our parentage well to play to our strengths. But even then, I think the challenges before us are so huge and need to be addressed so urgently. We believe that no single entity, regardless of how large they are or how well placed they are in this group, can afford to do this all alone. And what I find refreshing, Jessica, in our approach, and for many of those I see around us in our industry, is the fact that we proactively reach out to ecosystem collaborations as we look to co-create rather than compete between us whilst we solve for stakeholders.
Thank you very much, Zubin. Derek, I'd like to come to you, and thank you so much for joining us late in New York. You have, a global perspective at the forum, working with financial institutions all over the world, and the forum has been doing some great work around sustainable finance as well. So it'd be really wonderful to hear your perspectives on whether you think it's progressed, regressed, or neither, and what are your thoughts on the region?
Well, I hope you can hear me, by the way.
Yes, we can.
Fantastic. Listen, many economies historically have had really trouble attracting private capital in the context of, as we see right now, energy and the climate insecurity. If you add to that a very strong dollar, rising interest rates, sharply tightening financial conditions, and obviously what we have been observing recently, the misconception of ESG driving higher prices, well, all these elements are leading to broader pressures on the net zero agenda and the ESG investing broadly. This makes raising capital more difficult and impact obviously negatively climate finance as well as responsible investing. But nevertheless, there's a new wave of climate-related deal makers that we have seen recently, bolstered rather by the convergence of recent trends. Some of them Steve Howard has mentioned, and these include a staggering rise in extreme weather disasters, an international push for net zero emission targets, a set of new technology breakthrough that can potentially fight climate change are rising as well. So this for sure is supporting the investment narrative, and we see positive trends. Now, to some of your intervenants beforehand, I think questions are still open in terms of just transition and its consequences, the social impact of what these investments are going to produce. What about the political price of doing the right thing as well, from an environment perspective? So these are raising topics that remains to be, from my perspective, better considered, maybe even better understood. Jessica, back to you.
Thank you so much, Derek. I think you raised some really good points there, and I'm going to kind of, throw open this question to all four of you, and that is really at the top of mind. The Russia-Ukraine war has caused, this huge energy security crisis, and there's a whole conversation around how we've stepped backwards because we're seeing coal-fired power stations being fired up. We're seeing a lot of investments being, made into areas that, as Steve had mentioned in his earlier address, long-term carbon intensive. And so how are you seeing, this impact responsible investing in the short and the long term? Eric, perhaps I can come to you first.
Maybe I can share my thoughts first. I think, is it surprising that we need to keep people from freezing to death in European winters? The answer is no, right? So I think it's important that we're able to see the existing current position challenges for what it is. It is this year, the next couple of years, until Europe and the world refigures out its energy sources and supply and stuff like that. But it's important for us to be able to hold two thoughts in the same mind sphere, right? Which is, does that change net zero for 2050? I don't think there is any responsible investor or board or management or politician that's sitting here going, because of the Russia-Ukraine war, we're going to walk back on net zero commitments. I think what's happened is, like I said in my kind of opening remarks, is it's brought a lot more maturity around how to do that transition in a safe and equitable and just way, right? And so I don't think that the challenges of 2022 to, call it 2024, right, however long this crisis lasts, is going to change the long-term trajectory. And I think looking at the actions of the main economy, of politicians, et cetera, once this crisis eases, you're going to see that whole commitment back to, hey, private economy, main economy players, financial institutions, are you doing your part in this longer march? So we need to be able to hold those two thoughts in their particular timeframes and stay the course for the long term.
Thank you so much, Eric. I think that's very eloquently put. Derek, I want to come to you. I mean, you're much closer to Europe. How do you see this playing out, and how do you see this impacting responsible investment policies?
Thanks, Jessica. Well, the current geopolitical context is anchored in the rupture we are witnessing in energy markets, questioning for the first time in years energy security. And this crisis has a dramatic impact on inflation, as we've seen, and economy in general. But what we are witnessing at the same time is a really strong response and momentum being built on the policy side. We made a term response to the energy crisis, and I would say the heightened focus on energy security and sustainability. And this has led to a set of acceleration of climate ambition. And if I look at a few examples that have been, some of them issued quite recently and even surprisingly so, which was really good news, the IRA, the Inflation Reduction Act in the US, which significantly improves the incentive for a range of clean energy solutions. And we are actively working with the Department of Energy and Federal Loan Office to better understand what it means for our to-abate sector. In Europe, you have the passage of the Repower EU, tripling the pace of energy transition. And there has been as well a similar scale of ambition in the UK, with the UK energy security strategy, driven by huge investments in offshore wind and nuclear energy. So for us, these are tremendous opportunities to be leveraged. And we are working with our constituents currently to better understand what they mean, and then how can this public finance push might catalyze private finance.
Thank you very much, Derek. Yuki, I come to you because we've heard from Derek about how this really is playing out, and it's encouraging to see still that long-term ambition, and Eric has also mentioned that. And I think, from the GFAN's perspective, are you seeing, I guess, the political will, the will of the financial institutions kind of still having the eye on the target, and what sort of challenges are the financial institutions facing?
Yeah, I totally agree with Eric and the other speakers about this is a short-term crisis, and the long-term goals are still the same, and nature is against us and the clock is against us. But also it kind of highlights the problem that our climate solutions, our financing towards net zero is not fast enough, and that we are caught up in this crisis and making it harder for ourselves. And I think for the finance sector, there's a lot of focus initially on getting our books in order, so looking at our portfolio, our finance portfolio, and trying to bring that down, and that was quite a short-term response by the finance sector. But now with the energy crisis, a lot of the eye is on what is the role of the finance sector in the real economy. Are we really putting the money into the right places, and is things flowing in a smooth way? Are we really helping that? So I think the focus has kind of shifted to the impact and the 4 strategies that I was talking about earlier. It is about getting the timing and the sufficient money at the right time in those 4 different buckets so that it flows quickly and at scale to the net zero transition that we want by 2050.
Thank you so much, Yuki. I'm going to come to Zubin. I know that you're involved in the Association of Banks. There's a task force on the common language and the sustainable investment guidelines. So where do you see convergence happening around the definitions? And from the regulatory perspective, what can we expect?
I mean, it's evident that ABS sees the fact that Singapore and the regions around are tremendous hubs for new wealth creation and wealth generation. The fact that they're seeing the trends that Asian investors are actively seeking more responsible investment opportunities, particularly the next gen. And in terms of convergence, if I look at it, I think ABS did an excellent job to bring industry participants. First, to get private banks to come and work together, to then arrive at what was much needed in terms of a common language between them, and then to agree on an approach which would eventually mean more clarity and more transparency to the end client. So that's very encouraging. At Bank of Singapore, we were privileged to co-chair this task force along with UOB. And there were other industry participants from local and international private banks, leading minds who put their best practices in sharing this together for us to come towards a 2.0 version of what we thought would be more suited for Singapore and the region. I believe when these guidelines get announced, they should be the first such guidelines, at least in our part of the world. And they will, in some measure, benefit Singapore's aim to become a sustainability hub in the region. You asked about regulations. I mean, it's clear where regulations are going. If you look at the activity in these last few years, you look at the SFDR in Europe, you look at the MAS, Environmental Risk Management Guidelines, closer home. Even more recent is the Hong Kong Climate Risk Management Guidelines. It's clear again that this is here to stay, that direction's not going away. Many of us have played our part in voluntarily doing what we need to on this important issue, but regulation gives a focus, a sense of urgency, and that's clearly here to stay. I think another area where regulation will have no choice but to kind of come in is in terms of carbon emissions reduction. Singapore is playing its part with the carbon tax, and you should see more in the region start to do that pretty soon.
Thank you very much, Zubin. Derek, I want to bring you in because obviously Europe has been leading on this front in terms of having a common language, putting in regulations, especially the SFDR, as Zubin had mentioned. Where do you see that going? Do you see regulations, kind of picking up pace, and do you see a sort of convergence globally? Because I mean, the criteria you have in Europe is very different, I guess, maybe for Asia, and would love to hear your thoughts on that.
there is no doubt on our side that there's a requirement for convergence of taxonomy, regulatory framework, without a doubt. So we all speak the same languages, and it avoids most probably as well temptation for greenwashing. At the same time as well, the public sector, I believe, has a key role to play in terms of supporting, improving the risk-return profile of some of this investment that needs to be made, looking at concessionary capital, coalesce around multi-stakeholder transition finance ecosystem, where again, regulation is key, but not only, we talked about it, clearer governance, clearer standards, clearer guidance. But I think we need to pay attention to stay away from perverse incentives that could be as well coming out of these discussions. On taxonomy and standards, from the rough perspective, the work we have been doing there, it's pretty much what we call stakeholder capitalism, where we have consulted together with the 4 large big accounting firms with more than hundreds of CEOs, around 300 of them, I believe. We have built up a set of ESG metrics, which we have reported back to the ISSB, and it is being used as one of the sources for the reporting standard to be published soon. So this was the humble contribution, I would say, of the forum, looking at it from a private perspective and reporting back to the people who are going to define the way that it is going to look going forward.
Thank you very much, Derek. And I think on the topic of the taxonomy, we're going to have an exciting fireside chat at lunch with Dr. Ma Jin, who is the chair of the China Green Finance Task Force and also the G20 chair of the taxonomy. So going to Yuki, perhaps you can offer us perspective on the regulation perspective. I know the UN Race to Zero has just issued some thoughts around a compliance mechanism, which means that financial institutions are actually going to have consequences if they don't live up to the pledges they're making. How are we thinking about the legislation, or like basically the ability for financial institutions to make their pledges?
Yeah, so there's a lot of controversy and a lot of confusion about what is the right thing to do for financial institutions and what does their net zero commitment mean. First of all, just to clarify that after the Race to Zero issued its opinion or clarification, criteria, updated criteria, they have actually issued a clarification note last Friday, which kind of backtracks in a way what they were saying, in the sense that they're not going to be policing per se. What is clear is that the 1.5 measurement commitment, 1.5 degree commitment still stands. But how you do that is really up to each alliances, and that they need to police themselves, and that it needs to be in accordance with legal, regulation and so forth. But what is probably more important in that conversation is that I think we are at a point where when FIs, financial institutions, talk about 1.5 degree commitment, it has to really come as a result of moving the needle of the real economy to 1.5 degrees, and that their portfolio cannot go first. It has to come as a result of supporting their customers in that journey, and as a result, getting that. So divestment could be the easy way out, but that should not be, that's a very short-term fix, and you will realize over the long term that if you didn't change the real economy, you're going to be stuck in a tight corner and will not be able to achieve the 1.5 degree pathway anyway. And so I think we are at the point where, the managed phase out conversation is coming into play, especially in Asia, or like transition financing of the real economy is coming in. And this is a harder conversation to have because it's not a black and white. And you could actually be, an international bank might be asked to take on more co-financing assets to do the managed phase out. And are they, do they feel comfortable enough to do that right now? I think it's quite difficult, because we lack the clarity, of what is a credible financing for managed phase out. And this is the kind of things that we still have a lot of lack of standardization and measurement and KPIs around it. So this is what we want to work on at GFANZ next year, both at the Asia level, but also at the global level as well.
Yeah, I think you raised a very interesting point about divestments. And I think that, in the eco-business coverage on this issue as well, there has been a growing momentum for financial institutions, pension funds, universities to divest. But they divest, and these assets that are again taken up by private equity, they're completely opaque. They're not mandated to disclose, and it has zero impact on the economy. And I think that's been quite hard to grapple for civic societies who have been calling for that. And then people trying to explain that, this doesn't necessarily mean that we're going to see the results that we want. I mean, any of you.
I love to pile in on this conversation because it's a big passion topic for me, right? And I agree, right? In UOB, we have a saying, there's no point getting the financial portfolio to net zero if the main economy doesn't get there, right? So you almost have to lean in and stay with the main economy to push, cajole, pull, influence, as many action words as you can think of, because it's going to take all of those action words to be able to bring the main economy along. So for me, the asset test is very simple, right? If I generate green and sustainable assets in my portfolio today out of my Asia or Asean footprint, I can turn to my European and American capital markets and say, hey, capital market investors, I have a sustainable or green bond. Would you like to invest in this? And the take-up rate, the oversubscription rate will be huge. But I know, and we all know, and that's what kind of Yuki and Jessica are talking about, if I were to go into transition financing, and then I turned around to the European and American capital markets and go, hey, I got a great piece of transition finance bond, right? And in it is all the hard-to-abate sectors, financing, right? I can tell a beautiful story around it. And they'll go, we prefer your green and sustainable bond. Do you have more of that, right? And so until we can get a level of coordination across developing and developed national governments that recognize the different pathways that are required across different countries, across sectors within those different countries, a common taxonomy or language around, therefore, the transition financing and pathways that are required, and be able to get it to a point where commercially and reputationally, a bank like UOB can print those assets in the main economy on the ground, and with great security and sense of confidence, move to developed markets and say, finance this, and investors in those parts of the world go, great, because it's exactly what we want to put our money to use, right? That is my holy grail. And I think there's a lot of work that needs to be done to get us there, but that is absolutely what we, in developing market banks, need to be hunting. And that's where the ecosystem partnership with central banks through NGFS, with GFANZ, with NZBA, with our banking institutions and forums like this is that big piece of continued conversation, influence, and alignment that we want to continue to push.
Thank you so much, Eric. Very well put. Derek, I saw you smiling because the European markets, what are they looking for? Maybe you can give your perspective.
Well, first of all, let me just maybe briefly elaborate on the work that we've been doing in the context of the energy transition, especially part to abate. So as you know, there is action needed without a doubt to help these heavy industries on the transport side, on the construction side, for example. We have done a lot of work on steel, on aviation, on shipping. And we have been focusing on financing, reflecting on the de-risking mechanism which are required, the private-public collaboration that are required as well, trying to be as innovative as we can in terms of the investment tool. We have been looking as well at the policy that are required. We are engaging with the policymakers at the moment with the European Union, as well as the US with the Department of Energy mainly. And the idea really is to have them reflect on what finance require in order to mobilize capital at scale. And finally, we are building up a set of tools to build up a bit of a market, if you wish, building demand signals. It's called the First Mover Coalition. We have 50 plus CEOs and 10 countries who are formulating a set of aggregate demand commitments to build up this early market for innovative clean technologies. So I think that we are doing a lot of progresses, and there's a huge willingness. Obviously, the stress testing against climate change is not too far away. That's a quite big incentive for many of these institutions to join us in our dialogue, to continue having this discussion. I think what we have seen and the challenges that are there, the biggest one probably is a bit of a mismatch in the opportunity profile between the capital supply and the demand. There's probably as well a limited pipeline of bankable projects. It's coming, but extremely slowly. There's a certain level of trust that needs to be built as well between the hard-to-abate industries and their financiers to be able to have these adult conversations, let's say. Political and regulatory uncertainty, extremely important too. And finally, there's limited data and clarity on pathways. Nevertheless, there's been a lot of work being done on sector transition strategy, on climate-aligned finance, as well as the good work that GFund has been done, that now we need to kind of take and start to reflect more on going from commitments to action. But without a doubt, Americans and Europeans are getting ready. They are in the room with us at least, looking for opportunities. But again, the risk profile, the long tenors, the high level of complexity as well in terms of educating their staff to understand it, adapting the credit risk process takes quite some time, but we get there.
Thank you very much, Derek. I think that was the catalytic capital that we were talking about and how it can really spur some of the investments needed where the political and financial risks profile is not usually acceptable. I'd like to throw open the panel to our guests here today. Can we get the results of the poll if it's available on just very quickly? Okay. This is the optimism that we need. I was afraid everyone's going to say it's regressed, but 77% has said it's progressed. In that same Slido slide, you can submit your questions. For those joining us virtually, please do join us on there. For people in the room, any questions? Any burning questions for our panelists or reflections? No? Really? Okay. We have, okay. We have this lady here, if we can have a microphone to her. And then who was the second person? Okay, there. Come to you.
Thank you. Thanks everyone for the insightful panel. I loved, Eric, when you mentioned needing to increase the uptake for transition finance. I've been thinking much of the same. Divestment is easy to wash your hands off of a situation and not manage the risk, but you actually need a lot of those assets and businesses today to transition, to do it in a just way so people still have their jobs, etc. What do you think are the main barriers to that happening today? And who would, if you could assemble your dream team, who needs to come together to build demand for transition finance?
So I'll give you the system components I think are important. The dream team you go assemble for me after I tell you, right? I think it's important that we convert national government commitments, because right now, if you look across the various developing countries, every country has an NDC commitment, right? It would be 2050, 2060, and that's great, right? But to be able to then convert it into sectoral pathways and development roadmaps that align with those 2050 or 2060 net zero targets. Very similar to a bit like what Singapore is trying to do, right? There is the, hey, we'll be net zero by 2050, mid-century. We really mean 2050, right? But then to be able to convert that into what does that mean for transportation, energy, built environment, et cetera, et cetera. And the reason that's important is it begins to build out a lens of how you will decommission existing assets and how you will build up new economy assets. And that does the following things. Number one, it takes the investment risk out of a lot of the new builds, right? It allows for capital to move into some of the new economy with much greater confidence in terms of demand that will be coming, pushed by regulation and national development pathways. It allows the main economy players, especially SMEs, to be able to put themselves out there, link up with larger companies, ecosystem players to say, hey, we're plugging into a national development plan, all of us on the same page, right? Right. So it allows that capital to unlock into the new economy. But that same plan allows for a justified and reputationally a safer way to put transition finance to use, because you can see that almost like clutching down and clutching up, right? And once you have national sectoral pathways that can show the clutch down and clutch up, those transition pathways need to be articulated and agreed more globally, so that, again, developed markets can look at the developing markets and go, we know what you're trying to do. So every dollar that goes into, winding down oil and gas, coal, old economy assets, we get why you're putting the money in there. And with that level of confidence, the private markets, the institutional investors, the banks can now participate much safely. In essence, take the defending of transition finance out of each individual organization and put that defending of transition finance at a national level agreed pathway, and let us do what we do best, which is pile in, right, finance, run commerciality, and drive the main economy, right, both from a wind down and wind up perspective. That dream team is going to be hard to build, but right.
I think Minister needed to hear that, but we will take that up with her. Oh, we had a question here from Liang Lei. Go ahead.
Hi, morning. I'm Liang Lei from Eco Business. Thanks for sharing your thoughts. My question is mainly for Eric. You mentioned just now that the conversation in Asia is maturing towards a just transition. Do you mind if I just ask, what are the main thrusts of the conversation now, and does a just transition in the Asia region necessarily mean moderating the pace of the energy transition? Thank you.
Such a great question. So when I say the conversation around a just transition is developing, interestingly, it's not developing out of Asia as much. It's this recognition actually out from the developed world that if you need to crack the energy transition and net zero pathways for developing parts of the world, you have to accept that the global pathways may not work one size fits all. You need to be able to contextualize it to the economic scenario and starting point and differentiated pathways of each of these developing economies. Take, for example, GFANZ, right? GFANZ didn't stay global. GFANZ came to Asia, went to Africa, et cetera, et cetera. It's that recognition that you need to have different pathways. At the same time, I think if I were just to take the Asian companies, right? Countries and ASEAN countries, we recognize that we need to lean in and participate towards net zero. But at the same time, there is a huge level of practical reality there that says we will move towards decarbonization, but we must still support economic development. We must feed our people. We must make sure that energy security, access and affordability is still top of the agenda. So what you begin to see is recognition from the developed world that it needs to be multiple speeds, and the confidence from the developing world to say we will deliver to net zero, but in a way that takes care of our economies and our populations. And it's that kind of, a slow shuffling of agreement that I think is important. Now, we need it faster, we need it clearer, but who didn't need net zero yesterday, right? We get that, right? So I think it's just that continued effort to have that meeting of minds across the two sides of the world.
Any other? Okay, question from Thomas. We have the microphone. Thank you.
It's probably more of a political question. So the minister this morning said that we now all agree to global warming and net zero. I would argue that there's a couple of governors in the US who might disagree with that statement. And I'm curious to hear from a more political point of view whether you think that that's noise that will simply just be in the background, or you actually see that as a global challenge towards financing and making some of the things happen that we've seen today. So noise or a real problem?
Great question. Anyone?
Well, let me try. So I think there's the natural science, reaction to this, that there is a lot of scientific evidence, and we are already seeing the effects of climate change and loss of biodiversity really hitting our society and our economy as well. So I think we are being pushed into a corner where we have less area to maneuver and less options to take, and the coal and there are a lot of economic interests out there that still want to maintain the the business as usual. But I think one thing to say is that if you see the pathway of how sustainable finance has evolved, initially it has started off from a defense mechanism. It's a risk management, and a lot of the regulators have also started from climate as a risk to the financial system. But then when you look at the risk, you find that today the risk is become globalized and is in all economies. And so what that means is that if you want to risk manage it, you can actually reduce that risk or take it away unless you are part of the solution. You can no longer just cut it off and then you deal with the rest. You have to manage it in a way that you have to solve it. And I think that means that you kind of come back into the circle to say that trying to put that under the sand or to say that it doesn't exist is really going to come back to say that you actually have to solve it at some point. And so I guess it is a populist move, and it is part of the just transition conversation as well, that polarizing the conversation is actually a reaction to the fear that they will be left behind. So the more we can bring more of the transition financing and the managed phase out discussion into the arena of high emitting states is actually more beneficial for both those that are in that community that are afraid to change, is something that we need to do. So rather than brush them away, we need to embrace that fear and to try and, move with them.
Thank you very much, Yuki. I think we're going to wrap up the panel with a final question from me, and that really is, what do you hope to see in the next year that will really move the needle for responsible investing? And I say next year because I can come back next year and hold all of you account to it. Derek, we'll start with you.
So from my side, clearly, recently we have seen multiple public and private stakeholders making these commitments. And to Yuki's point, it's really moving from commitment to action. And it's not simple undertaking. But I think that the financiers have created a huge pressure to themselves, and now they have to deliver. And this is where, on our side, we are attempting to act as an enabler to facilitate this dialogue. But I think that what I want to see continuing to happen is really what we have seen in the past couple of months in terms of really large policy scheme and investment structure put in place by government. Because as long as I think we have the right policy, the right incentives, that we make this project somehow bankable, private capital is going to follow suit. So there's a matter of education, there's a matter of collaboration, but I believe that it's going in the right direction, most probably not fast enough. And to Thomas' point, the political price, again, of doing the right thing is extremely high. And that's what we are learning as we speak in countries such as France and certain states in the US. And I think there's a lot of thinking that needs to be done in terms of the narrative as well.
Thank you so much, Derek, for making that really good point about the political price. And I think that then it comes down to our responsibility as the electorate to be putting the right leaders into power. Eric.
I'm going to go slightly philosophical here. And I think what we've seen over the last 12 to 18 months is this strengthening of the zeitgeist, right? This feeling of the spirit of the times, that sustainability is here, it's important, it's not going away, and we need to lean into it. I want to, and I think this is tremendously important, to see that continuing of that spirit of the times. Because I think, when we talk about political pressure, when we talk about commercial business leaders making the right calls, when we talk about civic society leaning in, when that spirit of the times is so strong that you understand this is where you need to go, every part of society, be it commercial, political, or civic society leans in, this is where you unlock 7 billion points of light in being able to push towards this future. So I think as much as we can work out the tools, the mechanisms, the policies, etc., and that's all absolutely critical in terms of tactically delivering to net zero, we need to continue to protect and push that zeitgeist of sustainability, as this is what we as humanity and as a global economy need to lean into and deliver for future generations.
Thank you so much, Eric. I love the idea of the zeitgeist, and that's also why we did the poll, to kind of poll the room here today. And I'm so glad that, you know, the people here in this room are here because we want to have that conversation and the necessity to push that conversation. Thank you for that. Zubin?
Well, it was clear with the polling that the room is fairly optimistic on this. And if you look at post-pandemic, I think there was a sense of urgency and a sense of agility to address many of the issues which we'd kept aside for later, you know, issues around climate resilience or resource resilience, or addressing the fragilities of global supply chain. And I'm an eternal optimist, and I'd like to believe that the lessons we've learned and the momentum we've created is here to stay. And Asia will emerge stronger and more sustainable post-pandemic. And these same learnings and the same momentum will be the needle mover for responsible investment for years to come.
Thank you very much, Zubin. And finally, Yuki.
Yeah, I hope that we can start to talk about how do we get capital to be moving into the emerging markets on net zero, because this is really going to be the next important thing. And as Derek was saying earlier, we need concessionary capital, we need governments going in there, MDBs, and the private finance coming in. So I hope that starts to have a momentum this coming year.
Thank you very much, Yuki. I think the point about emerging markets had been mentioned by many speakers, and how we really need to be putting catalytic capital, transition finance. And on that note, please join me to thank my panelists for such an insightful discussion. We've covered so much ground. Thank you so much, Derek from New York as well.